Good afternoon, everyone. Welcome to the Everyday Trader. This is Greg. Glad to be back with you after a sunny trip to San Diego. My goodness, that place is beautiful. Eric?
Yeah. I don't now we know why like 72 in the evenings or during the day, blue skies, beautiful sunsets, a mild like in the mid 50s at night. I know why people live there.
We just went to a conference in about decentralized finance, cryptocurrency, the role in that. And we'll get to that as well because it was a fascinating conference. We had a couple of members of the FOMC there, as well as several chief economists from different Fortune 500 companies as well. But before we get to that, talk about today's market. Kind of got a mixed market today. We've got an outperforming NASDAQ that's up today about 0.5%, about 68 points. I know the market's not closed yet, so it's going to bounce around. S&P's basically flatlined. And then the Dow is down just slightly. The Russell 2000 is actually having the best day today. And really it comes on the heels of a huge beat in retail sales. The retail sales report was a really strong number, beating across the board for the most part, but especially showing strength in leisure, in shopping at big box retailers and going out to eat. Those types of line items were big beats on the retail sales report. And there's some interesting opinions as to why that's happening. This kind of ties into the CPI, the stronger than expected CPI report that we got yesterday as well. But Eric, I know you would specifically are talking about a report that you had read that was talking about this retail sales. I want you to jump into details to share with everybody on that.
Yeah, so full disclosure, I'll give credit to Sam Rines from Corbu for sharing that. Sam does a good job pointing it out. But I wanted to show this is the consensus range for retail sales that came out. Consensus was 0.3 to 1%. We were at a whopping 3%. Just blew the number. So this data comes from the U.S. Census Bureau. It's a monthly report on retail sales. And so here's a chart that shows the different categories of retail sales. And so here's November with the total number being the black line, which is broken up by ex-auto, auto, and general merchandise. So here's November, here's December. Look at January, just kaboom, huge 3% growth month over month, which blew all analysts out of the water, really surprised the market, I think. And initially we had a pretty bearish response to the market. And I think, that brings to the question of we're somewhere also vacillating between this good news is good news and bad news is bad news. So I think this morning, the initial read was that this is good news, that we've got solid, an indication of a really solid boost in the consumer, which is we've seen in a number of different places that there's strong wages and the consumer is doing well on multiple metrics. And that ostensibly is going to lead to the fact that inflation is going to be sticky. And therefore, I think the logic for why the market initially pulled back is that the Fed is probably going to be more aggressive. It's all about the Fed. And is it 25 basis points? How many 25? Is it 50? Is it others? And I think that's what we saw. But this advanced monthly sales, and what I want to give credit to Sam for is in his newsletter, he pointed out that there was some research done back in the GFC, the global financial crisis, that as part of the ARRA, the American Recovery, whatever the act was that was passed, where we had a lot of stimulus that went in. There were $250 one-time payments that were given and had a measurable $250 payments that were given to all recipients of Social Security. And that had a measurable and significant impact across the economy that can be seen in the study that he cited in this report. Well, what happened as of January 1st, most of us probably unaware, was a 8.7% increase for cost of living, which works out to be $140 a month being put into the paychecks of Social Security recipients or into the checks, an extra $140 a month And Sam's point is, where do you think that money went? Greg, we were talking about ahead of time. Where did that $140 go?
Well, when you think about the age of people who are getting Social Security, and I guarantee what they didn't do is hop on their Amazon app and start browsing the new shoes that they've been looking at recently, or where it went is they went out to eat. They went to the mall and bought some and went shopping, or they went to Costco.
They went and got some Skechers, and then they went
to get some Skechers, right?
And then they went to Buffalo Wild Wings, right?
Yep. So yeah, they spent it, and especially, our consumer hasn't changed. We get money and we spend it. We saw that the last couple of years when we got our stimulus checks, and yes, and a lot of people say, yeah, but we changed. We saw the savings rate go up drastically. Well, that's only because we couldn't go outside, and everything was locked down because of COVID, and so we couldn't spend our money. And once it got reopened and we had all this stimulus money, we went gangbusters, and that's the issue that's driven our inflation. I think it's actually a little bit concerning that the market is missing this bad, in my opinion. I mean, we have hot employment, we have hot retail sales, we have a Fed that's leaning hawkish, we have a hot CPI data, but yet the only thing that matters right now seems like is liquidity and price action, and that's to the upside right now. The problem is that won't last forever, because eventually the market is going to have to price in the idea that this Federal Reserve is going to keep interest rates higher for longer. And that's not priced in the current values of stocks right now. We're going to have to readjust for price eventually. Now, the question is when, but we had some interesting conversations about that at that conference this weekend as well. I know we're not jumping there yet, but because I'm sure we want to talk a little bit more about this hot data. On one hand, I think it's great that we have this data, because it's showing that the consumer is resilient, that they're not worried about the headlines out there about this massive recession. They're out there spending money. They're confident. They have jobs. Those are all good things. That it's really hard to fall into recession when you have a confident consumer out there spending. The downside of it is it could reignite inflation. That so far it looked like the Fed had been slowing the CPI down. Hopefully we don't see it start to pick back up again after this number that we just got from January.
Yeah. So to be clear, this is the rate of increase. So the rate of increase coming down is still inflation is still increasing. I had one of our community members saying, "I'm paying more for eggs. What do you mean CPI is coming down?" And so it's like it's like you're bleeding, but you're bleeding less. So we measure that improvement. We're used to the government talking about cutting spending and saying we're cutting spending. We're still spending more. We're just spending less than we were than the increase. So this is the rate of increase, and the rate of increase is leveling off, which is concerning. And when you dove into the number and looked at it and just draw a line between goods and services, we're seeing goods coming down and services going up. And that ties in to, which is a little bit of an alarm to what we saw in this retail sales number, is that there's goods that are being purchased, but the biggest areas was, as Greg pointed out, restaurants. People are going out and spending money. That's services. And so we're seeing that in a couple different indicators, and with a really, piggybacking on top of a very hot jobs number that we just got, with unemployment being near a 60-year low or 59-year low or something like that. We had some interesting conversations at this digital money, decentralized finance, and the puzzle of crypto conference in California. And speaking of unemployment, I remember one of the economists there saying, he's very bullish and he doesn't fly with the rest of the flock, but you know what I'm talking about. He thinks that we're going to see unemployment number. We might see a 3.00 on unemployment. So he thinks it could go down. Now, what does that all spell for, those are good things. So people having more money, people spending more money, people having more jobs. Why is that a bad thing? Why do we care about it? Is the Fed. And I popped up this chart of the SPY, because it was in July, and when we had, in this period of time is when we had that really hot CPI print, the first one that was 5%. And Chris Waller we were at that conference in the Rocky Mountain Economic Summit out in Jackson Hole when that report came out, and the market just ignored. I mean, the Fed, Waller said 75, and his speech said 75, and that's what was reported in the Wall Street Journal. But verbally, he said 100. He said, "Don't, we might even raise 100," and we did in fact raise 75, which nobody believed that was going to happen, and the market plowed higher. And I'm seeing a parallel, an analogy right here. I think that it's the credibility of the Fed that people are pricing in. Was it 25 basis points or something like that? I wouldn't be surprised if we see a 50 basis point hike, because the Fed is really concerned. We know this, we know this, you and I know this, firsthand conversations with Fed members. We were fortunate enough last week to be able to speak with Chris Waller and Patrick Harker, who were there. I personally asked the question. It wasn't to really talk about economics and talk about forecast. Those information are out there. But I did ask the question about is it concerning that we're seeing wage inflation going up? Do we need to see pressure on jobs in order to get inflation under control? And I'm telling you, the Fed is looking at this services component, which I don't think anybody's paying attention to that, because that's the explanation for why we're not seeing a much lower number come down, is that wages are strong. My son, by the way, my son just got a $10,000 pay raise yesterday. He's a young guy. They offered him something, he pushed back, and they actually increased it even more because he's got recruiters coming after him. So he got a really nice pay raise yesterday. I mean, that's just one anecdote. But how are we going to get CPI under control if we've got cost of living and other things going up? So you see that Social Security going up as well. It's a bit of a concern, I think, from people who are prognosticating on the market. I think the trend is your friend. I think technically we're going to keep going higher until we get to the next Fed meeting, and they'll, there may be some hiccups along the way, but I do not think the market is pricing in. And I think you and I were saying this doesn't make sense back in July and August. Why is the market going higher? The Fed is they're really going to ratchet down rates. And the market didn't believe it. I mean, I know firsthand, talking to fund managers who run billions and billions of dollars, saying, we don't think the Fed's going to tighten that much. We just don't believe it. And I think that's the same thing that's going on now. So stick with the trend as your friend, but I think you should be prepared. And what it's market timing. Nobody's ever great at market timing. I think you should be prepared, batten down your hatches and have dry powder so you can take advantage of things and protect yourself. What I think you can predict is when there's going to be pivots. And so these major economic reports, the PCE and the next Fed meeting, are the periods of time when we need to be looking for pivots and when we're going to see the markets change.
So I couldn't agree more. I think the market's irrational. It's illogical to the upside right now, but that is the trend, and you got to trade it. I mean, just look what Bitcoin's doing today. I mean, Bitcoin's up 6% today on really no news. I mean, the dollar's up. And so we're starting to turn into maybe that FOMO mentality again today. And we may, for the next couple of weeks, maybe even up to the next Fed meeting. You're right. So let's switch gears. Let's talk a little bit about Bitcoin. Let's talk about some of the more granular pieces of this conference we went to, because I was actually very impressed. There was a couple of executives there from the crypto space. I forget what his title was. I want to say he was like the vice president of asset allocations at Coinbase.
Head of asset allocators.
Head of asset.
So he works with family offices and other anybody looking to get to invest with Coinbase, so that are looking to manage funds. So he works with pension funds and family offices and other large investors. Yeah, so he was great. There was a couple of other fund managers there from Wisdom Tree, as well as Fidelity's head of digital assets was there, and then some other big fund managers as well that
are investing in the space or looking to invest in the space. And it was kind of interesting seeing the back and forth between the younger crowd and the older, more established retirement, fiduciary type crowd. And I didn't hear the words "Hey Boomer" once, but it sure felt like they were going to drop the word "boomer" in there somewhere. But it was a very enlightening discussion. I'll be honest.
Let's just run through some of the highlights and start.
Yeah.
So the first presentation was, and we'll get into some of that. I think when I unpeel some of what you just said there, the first presentation was by Chris Waller, and his comments are out there. So Eric Rosengren, who left the Fed for the opportunity to spend more time with his family after he was trading before Fed announcements. Yeah, that's a euphemism for he was asked to leave the company. Spend more time with your family. He was one of the Fed presidents who was actually trading their accounts and didn't see anything wrong with that the day before. Anyways, I shouldn't say I don't know for sure that that's what's going on, but let's just say Eric's spending more time with his family. Eric was the president of the Boston Fed, and he was working with MIT on a white paper for looking at central bank digital currency. And that's something that's going to make a lot of alarms go off. I would say that I lean a lot libertarian. Okay, so here's my Libertarian Party pin. I have a Libertarian card. Also, my American flag. I'm a proud American, but I lean a little bit libertarian. And I'm not a big fan of the concept of central bank digital currencies. I see some of the pros and cons of it. And I would say if you are of the ilk that I am, and I know, Greg, I know you lean a little libertarian as well, you should be comforted knowing that Chris Waller is in the place that he is. We also had another major development that happened just today, just yesterday on the Fed. And it's related to this because Chris Waller is steadfastly opposed to the notion of a central bank digital currency because his words are, and they're out there, this is public, is what problem does it solve? What is what is not done by what exists right now? Because we have digital clearing, we have electronic money right now. What is the problem? The biggest proponent of it, the one who was most in favor of it, was Lael Brainerd. Yeah. And so Lael is now leaving the Federal Reserve to go spend time working to lead the Economic Council for the White House. So good for Lael. It's a big opportunity for her to work on the Biden administration. I don't know if you saw this today, but the rumor is that Austin Goolsbee, who's from the University, his name was floated today in the Journal as potentially taking her place. Now, he is not a dove. My fear was that it would be somebody like Stephanie Kelton. She wrote the book. She wrote the book on modern monetary theater, and she was actually an advisor to the Biden campaign. So she scared the daylights out of me that she might make it onto the Fed. I was only half joking when I tweeted that out. But it looks like Austin Goolsbee, they'll fill a spot. So there'll be somebody else coming on the Fed. But Lael will take. So Lael was the vice chairman to Jerome Powell. And I think Austin, I've had the chance to meet him before at actually some University of Chicago events. He's a really, really sharp guy. He is not necessarily a hawk, but he's more central. So I think be really interesting to see what he brings to the Fed if he takes that position. But back to the central bank digital currency thing. It's not a done deal because there are members of the party on the left and the right. So both blue and red are very much in support of the notion of central bank digital currency. It enables things like one of the stories that came up was in China. They have a central bank digital currency, and they had some regional economic issues that were due to weather, and they wanted to try and stimulate the economy. So they gave exploding money to people. So all of the people who lived in these provinces got 400 yuan that expired in 2 weeks. So you got 400 yuan, you got to go spend it, and you got to spend it right away. Otherwise you lose it. And so it's a great way to stimulate the economy. The problem is that you could go, Greg, your cholesterol level's a little high. No steak for you. Or that ammo that you want to buy, the green tips, nah, no more. Sorry, you can't buy that. So that when you have a central bank digital currency, it's a slippery slope that I'm sure some of our people listening to have some very strong opinions and emotion on it. But for those of you that lean against the idea, you should be happy that Chris Waller. Now, you heard Harker talk a little bit about it. I think he sees some of the benefits. So we'll see how that plays out, but you should keep an eye on it because it's something that they're looking at on the Fed.
One thing I would point out that both Harker and Waller stated is that this will not come from the Federal Reserve. I mean, even though, they may be the ones asked to engineer it, this decision will come from Congress if it happens. If the United States decides to go down the road of creating a central bank digital currency, it will not be the Federal Reserve that creates it. It will be the U.S. Congress that actually votes and passes on that. So,
well, gee, Greg, that makes me feel so much better.
So, we'll see where it ends up, where that plays out. I think one of the things that I walked away from, and to reiterate kind of the analogy that Waller used, and I think he's got a bigger voice on the Fed than people realize, to be honest.
He is JP's number 2 guy.
So. I think so too. And who knows? That would be interesting to see if he gets named as the
No. He would never. They're going to do somebody that's more on the
that's what I would hope.
It's not partisan, but they're not going to. But he is. He's basically a clone of Jerome Powell.
So his policy, his analogy that he used is digital currency, and he used specifically Bitcoin. He says, but all digital currencies for that matter, they have zero intrinsic value. Now, that doesn't mean they don't have a value, but that value is only what people are willing to pay for them based off of, in his view, as a kind of a collectible. I mean, almost like baseball cards. In fact, that's what the analogy he used when he compared digital currency to baseball cards. And, people will pay money for it. They will pay money for Bitcoin. Currently, they'll pay $23,747 for one Bitcoin. But they'll also pay $500,000 for a Michael Jordan rookie. So, who knows? Maybe he's got something.
Well, I mean, and he doesn't care about that. If you want to trade baseball cards, he's fine with that. So, it's I know that some people I agree. There is zero intrinsic value to Bitcoin. So, the guy from Coinbase made an argument over dinner that it was it's the cost to mine, that there's a floor at Bitcoin. Yeah. That's like arguing that the floor in the price of gold is the cost to get it out of the ground. There is a floor to gold, by the way. I mean, there's industrial applications of gold. It's not a particularly great material. Copper is actually better in a lot of different ways, but it does, it's got anti-corrosive properties and it's used in industrial applications. So there are some fundamental levels that do put a floor. But Bitcoin is like Buffett. When I went to the shareholder meeting last year, Buffett said, I wouldn't give you $10 for all the Bitcoin in the world. And the truth is, if you owned all the Bitcoin, it's worthless. It's only worth something because other people think it's worth something.
Yeah.
Which I don't know if we wanted to skip the DeFi conference, but maybe we can come back to that one if you want, because I know you like what some of the comments that were made from Coinbase, and I want to hear your thoughts again on that. But I wanted to skip over on this topic about, is it a new asset class? And Bill Kennedy, who's he's the chairman of the board for the Global Interdependence Center, but also the CEO and chief investment officer for RiskBridge Advisors. And what they do is they outsource chief investment officers. So pension plans or other funds that are looking, or family offices that are looking to hire a CIO, his organization does that. And Ian Toner was there for chief investment officer from Veris, Tom Jessup from Fidelity, and Michael Melvin was the moderator of the session, and he's from the University of California, San Diego. Which means, well, no, you know where I was going to go.
Channeling your inner Ron Burgundy there.
My Ron Burgundy, San Diego. Sorry, that came out of nowhere. Ian Toner had a quote that I thought was fantastic because he talked about the prudence because we talk about it, when you're an investment advisor and your job is recommending assets, you have to consider suitability. Is it something that's suitable for the people? Is it a prudent investment? And he had my favorite quote that I've heard for a long time, because he's talking a lot about prudence, the importance of prudence and making these decisions for other people. And he said, prudence hasn't been cool. No, he said, prudence has been cool exactly 2 times in history. In 1968, when the Beatles released Dear Prudence, and then again in 1983, when Susie and the Banshees did a cover of it, which I thought was freaking hilarious.
Yeah.
But it's an interesting concept, because what I took away from both of those guys, and I saw the newsletter from Bill Kennedy. He published a newsletter this week and basically went through and said, as a CIO, I don't think it's appropriate for me to be recommending this to people. So crypto's got a big hurdle to get over there, because that seemed to be the consensus I saw from the panels, although Fidelity was a little bit different. What were your thoughts on that panel there?
Yeah, no, I took the same away from what you did as well. As I think crypto has a long ways to go, and it's not just because of the crypto winter that we went through and all the fraud stories that have come up recently. And to be honest, they're not done. There's going to be more fraud stories that are going to come out in the crypto space. But I think one of the biggest things I took away from the only way for Bitcoin and any cryptocurrency to be able to cross that hurdle and get true investment from institutions. Now, that's not saying that there aren't some institutions, speculative hedge funds that may dip their toe into cryptocurrency and, get some exposure there. But that is so minuscule compared to the massive amount of funds that is, say, managed by CalPERS, which is the California, educators, the retirement pension fund that they run. And even some of the big, huge ETFs at Fidelity and Janus and the like, they're not going to touch crypto until there is a level of oversight. I'm going to use oversight rather than regulation, because I know regulation, I don't know, maybe it's just the same word, but there needs to be some level of comfort that another FTX isn't going to come around and woo investors. And now, instead of it being, institutional investors or young investors who have full-time jobs and have high-paying jobs and can afford to lose it, the risk that this group of people that they represent are, our school teachers and our firefighters and, people that don't have really high incomes, and they're putting their trust in the pension system, in a sense, that they then give that money to asset managers, that there's a responsibility that they have to put that in prudent investments, that crypto is just not going to be one of them. And so, yeah, it's a big challenge going forward, I think, for crypto to really truly get adopted in the investing world. And if they do, it kind of goes away, I think, from the original creation of Bitcoin, was to be decentralized. I mean, that was kind of one of the things that that Jim was saying, is that, at the core of Bitcoin was this idea that we're going to be decentralized and not controlled by these states and by the FTC and by the SEC and by the CFTC and all the governing bodies that ultimately funnel you back into the controls of government. And I don't know, it's kind of I walked away from it both optimistic about the future of blockchain and probably pessimistic about the future of the current existing cryptocurrencies, is I don't know that they're ever going to truly get the type of backing to get full acceptance as a legitimate currency or as a legitimate store of value.
I'm sharing the newsletter on the screen, and you can see it, right? This is Bill Kennedy's risk bridge report, this newsletter, and he talks about that a framework that he has in order to make decisions about investments, and it has to pass a few filters. And one is, how does the asset fit inside a risk allocation? Does it provide diversification, help control risk, enhance portfolio utility? How much portfolio risk budget is consumed by adding cryptocurrency. And then the second is, can we measure the asset's intrinsic value or an equilibrium price? Is there clearly a defined case? And we just discussed that there really isn't. And most importantly, is the asset compatible with the fiduciary responsibility of the client? And the answers across the board right now are no for him. And this is him. This is just one investment advisor who's, I think this is a big hurdle that crypto has a problem that they need to get over in order for this to become mainstream. And I think I wanted to jump back to the session before this, because I do think, if we expand our horizon, too often we think of crypto and we only think of FTX comes to mind, and of course either some of these crap coins that are out there or Bitcoin, but there's really the technology behind it is blockchain and the concept of DeFi, decentralized finance, which is really where the exciting thing comes from. And that the panel before it with WisdomTree and Coinbase and Jim Bianco, both on there, Don Rismuller was moderating the session. I thought it was fantastic. And this is, I think, where your optimism came from, right, Greg?
Yeah, it is. Yeah, I think there's an opportunity to fix some of the inefficiencies that exist in our marketplace, both in the transfer of funds as well as being able to eliminate middlemen in a lot of jobs that exist out there. And I think the more interesting part of this whole crypto space and this blockchain space and this decentralized finance is the people that it eliminates are brokerage firms. And so that it's kind of interesting that it seems like the number one opponent to crypto, the big name opponent to crypto out there is Jamie Dimon. And of course he's going to be, because he's smart enough to realize if this truly gets adopted, this online marketplace of exchange, and it may eliminate exchanges for that matter. I mean, the Chicago Merc, the New York Stock Exchange, the Chicago Board of Options Exchange, all those exchanges, the ICE, all of those are potentially at risk. That if I can do person-to-person transactions and eliminate costs and middlemen, that's the exciting change, and that's probably coming. We
know it's coming because one of the people that were there, William Peck from WisdomTree, was talking about their tokenization of different assets. And on a side conversation with Coinbase, they seem to be pretty excited about this tokenization thing. What does this mean? Is what is a token? You can think of a token as a poker chip. So everybody agrees that this poker chip has a set amount of value, and it's really easy to use. So that way you don't have to be making change and throwing dollars around at the casino. And when you leave the casino, you can trade it in. You shouldn't expect that the value of it's going to change. And you can do what you want with those poker chips pretty much anywhere you want. And one of the things that WisdomTree is working on is tokenization of some different. They're an ETF company. They create ETFs. Is this tokenization of ETFs, which will allow peer-to-peer trading of an asset with instantaneous clearing. So I want to sell my ETF, my S&P 500, whatever version of the SPY to you, or to anybody. I can see what the market price is, and I can just do it, and I can sell it instantly. I can get cash instantly. I can buy it and clear it. And you have that provenance, if you will. That's one of the benefits. People talk about contracts. What is this contracts benefit that we get from blockchain? And that's it, is the ability to have trust. And I think that's going to go huge. Not if you're just thinking about limiting yourself to this this concept of Bitcoin, which is it used by smugglers and drug dealers or whatever? Is it this YOLO okay boomer kind of thing? But there's actually, and everybody talks about the blockchain, and I think one of the things that I heard from Coinbase is saying look for in the next year the tokenization of physical assets.
Yeah.
So that we can trade physical assets with the prudence being proven using this blockchain technology. And this is the sort of DeFi thing that's really exciting that's coming. And you're right, it disintermediates all of the people in between. There's one party, like in the case of the Wisdom Tree example, you got to download the Wisdom Tree app, and you can only trade with other people on the Wisdom Tree app. And right now, the SEC won't allow you to trade with Fidelity and all these other companies. By the way, Fidelity and BlackRock and all these other companies, they're working on tokenization as well. And I think if there's enough momentum, the hope is that there will be one sort of central clearinghouse that allows for this to happen. On, like, right now you can buy a Bitcoin on Coinbase, and then you could take it to, I don't know, whoever, I don't know what the other exchanges are, but you can take your Bitcoin and go trade it anywhere, move it around, and move it to any other sort of platform. With the tokenization that exists right now of sort of equities, you'd be tied to whichever platform you're trading on. Which, what I'm thinking about is, I don't want to download, I've got an ETF that's Wisdom Tree, and I've got one that's Fidelity, and I got one that's BlackRock. I don't want 3 apps. I want one app.
Yeah.
And I think we'll get there eventually. That's pretty interesting and exciting.
Well, maybe we should see if we can find some links that we can put below to give you some more information on some of this stuff, because some of the research that's been done, I think Wisdom Tree is doing some great things here. Obviously, Coinbase is one of the leaders. They're one of the major exchanges. I did walk away with a little more confidence in who Coinbase was from this event. Now, that's not to say that there still may not be some ripple effects of some of the fraud exposure and some of the bad players that have been in the industry, that Coinbase still may not feel some of that. They may, but it felt like he did a really good job of presenting who Coinbase was and the future of what they expect.
Well, Coinbase is up 16% today.
Yeah, I'm sure.
It is. Sure I just happened to look. It was down big last week, and I think when we were there was a big 5% or 10% drop that happened. I think it was because the SEC. I guess it was Friday. The SEC put a notice out that it was going to put some limit on staking, and I'm not exactly sure. But the other, I was talking to Bianco on the side about the tokenization of these assets, these ETFs, that you'd be able to also stake those as well and get a return from them. So from his argument, so he's a bond trader, and which is traditionally very conservative, is that you could get this tokenized bond fund that pays a nice 6-7% yield with a very low risk. You could stake it and get another 3%. He says, why wouldn't you do that? You're making 9%, 8% with a high degree of confidence and low risk. It's pretty compelling. I gotta tell you though, Jim's brain operates at like a frequency that's like 2 or 3 times the normal human being, and he's like a 3D chess player. He's 6 heads moves ahead of everybody, so he's out there. All he does all day. This guy was talking to him. He has the TV on all day long, and it's either sports or it's Bloomberg, sometimes CNBC. He's on Twitter all the time. He reads everything I read plus more. I don't know how he can handle processing all that data, but he's got a pretty fascinating brain. It was good to spend some time with him. The last part on the agenda was this sort of, we got a bunch of people here. We don't know where to put them. The session of the misfit toys. I shouldn't say that because it really didn't kind of fit together. There was some people that I don't think we need to mention everybody, but one guy that was on there that was really cool has to be mentioned is Mark Mills. Mark is another one of these really big thinkers, and I think you should check out his podcast, The Last Optimist.
The Last Optimist, yeah.
Yeah, check out the last episode that he posted, and Mark, share your reactions on his presentation, because I was definitely left slack-jawed just watching him present.
There were a lot of really brilliant people there. I think Mark's another level. The guy is amazing. He is a brilliant, brilliant man. And the thing that I took away from his presentation was the future is so optimistic right now. The stuff that we are working on in artificial intelligence and the changes that are coming from that. This was all invented, 20 years ago. It's finally now coming to market. And the stuff that we're working on now, some of the chip technologies that are going to create this exponential growth in artificial intelligence it's as impactful of a change as the internet was when we launched the World Wide Web back in the early 90s. And so this is going to change the world, and it's going to change everything from the job market and automation of robots and some of the stuff that's going on there. He shared some examples of the first robot that was first created and put into production by General Motors, and then a current robot that Boston Dynamics is working on, or that it actually has in production right now. And it's quite amazing. The one thing that he came back to in his presentation is that all of this requires energy. And we have to be able to power all of these things. And the use of energy actually starts to become exponential as these things grow. And so the demand for energy, not just renewable forms of energy. I mean, he was very bullish and optimistic on the need for fossil fuels for a lot more than just the next 10 years that President Biden talked about in the State of the Union address.
We're going to need oil for 10 more years. And then
we're going to only need oil for 10.
No, yeah. Mark was one of these big thinkers who's got some expertise that has an interesting confluence of, his expertise in the oil, but also of internet and manufacturing. And Mark talked a lot about this exponential growth of everything in terms of processing power and need for energy and just the massive use of the cloud. He showed one data center that I think he quoted something like, this data center today, which is a massive data center, it's one of the biggest in the US, but to put things into perspective, uses as much electricity as Tokyo did in 1986 or something like that. It's just massive amounts of electricity that are being used. And all that's going to be driven by the need for raw materials. And this is the point of his most recent podcast, is that all of this stuff that we know is going to be built. And he made an argument that, things that are being commercialized now were invented 10 years ago. And that's, think about whatever field you're an expert in, you probably know something really cool that came out, but doesn't actually get commercialized into a consumer's hands until 8 to 10 years later. And just the things that we already know about, and we're not stopping, we're going to continue to innovate. All of it requires copper and lithium and nickel and cobalt and all these other resources. So he's made a sort of an argument that these commodity places, which is something I'm starting to think more about in terms of my due diligence, is taking a look at mining companies like maybe FCX or Freeport-McMoRan or Caterpillar. The chief economist from Caterpillar was also on this panel and talked about some really cool stuff that the Caterpillar's working on in terms of areas of automation and electrification of fleets. She had some really interesting sort of anecdotes. I don't know that I'm suggesting buying Caterpillar today, but I think 10 years from now, Caterpillar will be a lot better off than where it is now. So it was an interesting conference that we got a lot of things to think about. And I think I'll piggyback off of your comment, that is that I came away with a lot of optimism. Actually, I think that things are pretty good in terms of our future. A lot of more innovation coming down the road, and just we think that we've sort of at an endpoint, but it's a journey. It's going to continue to get better.
And had you bought Bitcoin when we started recording this, you'd be up $1,000.
Damn. Bye.
The FOMO is back.
Is that what it is? YOLO investing?
We'll see. We're above 24,000. It hasn't been this high in a little bit, so we'll see. Suppose we should wrap it up.
The market's not closed. I should go buy some stuff.
I guess you still could. Yeah. You still have 12 minutes. All right. Eric, it's been a pleasure.
Yeah.
Folks, thanks for joining us. Don't forget to click the buttons, like and subscribe. Feel free to ask, comments down below. We're always interested in feedback and having a conversation here as well. So again, thanks for joining us and look forward to seeing you in the next one.
Thanks, everybody.